Hey, my name is Castleigh Johnson. I am the CEO and founder of My Home Pathway, and thank you for joining our first AMA Ask Me Anything series. We are so excited to be here to share a little bit with you guys around what's the fastest way to get pre-approved. Simple answer, use My Home Pathway. We've been building this platform for a few years. We've gathered your feedback. We've worked with our partners, and we have a really solid platform that really helps you to better understand where you are in the homeownership journey, snapshotting your current state, your progress, and giving you the tools necessary to become a homeowner. And so today we're going to walk you through a little bit of, what does it take to actually start the journey and to get the pre-approval. And we'll ask your question. We'll answer your questions live, right? And so again, super excited for our first part of this AMA series. Look for us end of the month. Every month we'll be doing these AMA series. We'd love for you to join, share with your friends, spread the word, and ask questions, right? The series is here for you. It's here to make sure that you get the tools and tips and guidance you need to actually build the right profiles to get you qualified. Again, I'm Castleigh Johnson and super excited to be here. All right, so let's start off. The fastest way to get approved. We kind of hit this already, but again, I'm gonna reiterate because again, repetition is how you build muscle memory. Leverage My Own Pathway. That's how we actually get you pre-approved. And so what is it that really helps us understand your financial situation? For you to understand your financial situation, the first big step is what we consider the power of your profile. And what's the power of your profile? You have to really be able to understand you and your motivations, right? And where you currently are. And with that, you'll tell us a little bit about you, right? You tell us your ambitions, you tell us a little bit about and then you'll get connected, right? So there are bank partners that we have, there are credit bureau partners that we have, and income partners that we have that gives us a snapshot to be able to connect and tell you like, hey, here's where you are, Susan, Joe, Diego, and here's where you really need to be. But again, a lot of that really comes down to being able to provide that profile to us so that we can be able to snapshot you and help you understand where you are today. And so those are the couple critical things that we start with when we consider the power of your profile, your credit score, your banking data, and then your income data. And that gives us the ability to say, hey, here's where there's some things that we can help you with and on your journey to homeownership. So again, step one, same basic item, power of your profile. And with that, tell us a little bit about yourself, right? So we have some personal information that we're asking you, but that's really around helping us to better understand you at an individual level. And then we can then provide you the right guidance to help you to close those gaps, but as well as just get to know you a little bit. What's driving this change or this need or want for home ownership? And again, some of that stuff that we'll be able to, and this personal information also helps us to identify areas of opportunity for you. For example, there are down payment assistance programs that are tailored towards certain cities, certain localities, and that's free money. And if we know certain information about you, we can help you to identify where those down payment assistance programs are and what potential characteristics that you have as a consumer that's going to be able to, hey, I qualify for this down payment assistance program, right? Or I qualify for this special purpose credit program over here, right? So you really want to be able to provide that context so that we can help you, be able to identify some of those programs. So again, when you tell us stuff about you, it helps us to be able to provide you the best insight and more personalized guidance, right? So this is really not about us. It's really around how do we help you on your journey. Again, from there, we now look into what we consider, what are your ambitions in your current state? Like, where are you today, right? And that's when you connect your data, that allows us to be able to assess kind of where you are in the current state. And again, what are your, what types of your goals in terms of home ownership? Is it within 3 months, 6 months, a year, 5 years, right? And where are you looking, right? Are you looking to buy stuff where you are currently, or are you looking to move? And again, if you've been turned down for a mortgage, giving us that insight so we can know, like, hey, you've already been in this process, so you kind of know a little bit more than somebody who's never even been in the process. And again, if you are a military veteran, there are certain down payment assistance programs, which are grants and loan programs that can also help you to be able to find money for your closing costs as well as for your down payment to even get into a home. So the more you can provide us this information, is the more we can help you to understand where you are and to get to know your home buying needs and what's going to be better for you as an individual or as a family, right? Or a co-borrower if you're borrowing or intending to buy with a significant other, a partner, et cetera, a co-borrower. The more information that we can capture on both you guys, if you're co-borrowers, is the better it is for us to be able to help you. Again, this one is a pretty important one, right? Your credit score is one of the most critical things when it comes to home ownership. It is not the only critical item when it comes to actually underwriting and for banks and lenders being able to assess, hey, here's where you stand. But this is one of the most important ones. So on our platform, we've partnered with Critical Credit Bureau. And so for us to be able to connect your information, we need to actually get your consent as well as make sure that we are protecting your information the best way possible. So it is important for us to be able to know, hey, where is your credit score today, right? If it's under or below underwriting standards today, how do we make sure that we know where it is and how we can help you to improve that credit score to get you to underwriting level? And so that's really where we need to grab your credit score information. So it's a part of our overall gap assessment. And we're looking at hey, where are you today? Right? This credit score is a pretty critical area. And what are some things that we can recommend to you, right, to improve that credit score? So there's really important information that it helps us help you. That's how we have to think about this relationship is how do you give us enough information for us to really be able to personalize the recommendations and personalize the roadmap that we're giving you, and your credit score is a very critical area or part of that assessment and roadmap that we need to build. And again, these are things that our lenders and partners are going to need. And so for us to be able to give you the right guidance, connecting your credit score is a pretty critical area. But again, it's for us to be able to help you. Again, when we think about giving us a peek into your spending habits and debts, right? In terms of debts, it's really around leverage. How much more capacity do you have from your current, obligations, your creditor obligations? And if you're going to get a home, you're going to add another creditor obligation to that. You can typically swap out your rent payment for your mortgage payment. It may go up 20 or 15, 20%, sometimes even as high as 25% over what you're paying in rent, depending. Right, so if you're typically paying about $2,000 in rent, your mortgage may be $2,200, $2,500. But again, it lets us understand kind of where your current cash flow is, where your current expenses are, and how do we help you from a cash flow perspective. Cut down on your variable expenses. Even understanding what variable versus fixed expenses are is a pretty critical area, right? And so even if you don't quite know what variable versus fixed expenses are today, we're going to help you to understand that, right? Because those are critical areas that a lender is going to look at, and you as a consumer, you really need to understand that. It's very important for you to be able to understand what you look like from a lender's perspective, and that's our job, right? If you're not really built into finance, it can be intimidating. So, connecting that data allows us to be able to help you to understand, hey, here are my spending habits, here are my current debts, which is really around leverage. And from a leverage perspective, how much room do I have based on the income that I have coming in and the debts or the credit that I have to pay, the credits that I have to pay off, right? I only have a certain amount of leverage left, right? Non-free capacity. So you really want to be able to connect that data so that we can be able to help you in the best way to be able to grow this area, because this is typically one of the ones that people don't really think about, right? Your cash flow, your debts, and your spending, right? All of that impacts your ability to get into home ownership. And you want to really present the best picture to your lenders as to, hey, I'm a really serious buyer. I understand my spending habits and my financial habits are in a good place. So if you give me a loan, I'm not a high risk or I'm not a bad risk for you to work with. That's really what you're trying to show here. And then when it comes to income, you have to have sufficient income to cover the expense of a mortgage, right? And some people, your typical W-2s or your corporate employment or, your regular income, as some would consider it, versus what you consider now non-traditional income, whether it's gig workers, freelancers, you have 1099 is what some people would call. So there's, income comes in various ways. And really what an institution is going to be looking at, a bank partner is going to say, hey, do you have enough consistency in your income, right? If you're making 200,000 and then 40,000 and then 500,000 and then 60,000, it's going to show variability in income. And you look like a different risk, right? So what they're looking is, hey, for your current income level, what's about the amount of mortgages you're going to be able to afford, right, consistently, even when it's up and down, right? Or some people, again, if you're a W-2, you're typically more considered consistent on your income, but that's really where they're looking at from a risk perspective. But when you connect your data, connect your income, it gives us the ability to help you kind of better understand what your income is and again, what the blender will be looking at in terms of that income capacity, because that feeds into an area called debt to income ratio, which is what really they look at in terms of leverage, right? How much capacity do you have from your income versus your existing current debts? And so again, connecting your income data is super critical. We kind of talked about, again, banking data before, as well as your credit. This is the other component which comes into, setting up your complete profile on the platform is really connecting your income data here, right? So this is we're working with our partner Plaid for income and income verification. And then that way we'll be able to say, hey, here's your verified income to our partners to say, you've already done the critical work of showing us that you have income of a certain size. When we come into your exclusive personalized plan, right? So once that data is then connected, then we can say, hey, here are some places that we know you need some help. So you'll see kind of your high level snapshot of what you consider your dashboard. It's really around how kind of helping you understand where you stand. So obviously items in red need a bit more work. So you'll see on my credit score, I got a ton of work to do on my credit score. In this case, you'll see on my debt to income ratio, which is really around leverage, I'm making progress, right? I'm not too terrible, but I'm making some progress to get there. On the other side of my credit score, my down payment saved, I've saved enough, right? So I've already checked that box. So I won't really need to do much more there. You can continue to save, but it's not an area that's going to become a challenge for you getting through underwriting. Again, on the credit score side, you see I got quite a bit of work. On the debt to income side, making progress, not quite there. And on the income is verified, right? You can show connected, making $4,000 a month in a pretty good space. I can afford the type of home that I'm looking to be able to get to. So again, around this recommendation structure, wherever we've identified gaps, we give you recommendations that help you to address that gap. So you see a lot of these recommendations around your credit score. And so you'd be able to then action the credit score to your to-do list. And then you kick it off by executing on that. For example, if it's one of our partners to get rent reporting or for a credit builder loan, as we've shown an example here, you action it and then you actually execute on setting up that credit builder loan. And that will actually drive, for example, your credit score anywhere between 20, 30, or 50 points. And we can see and verify that action and that you actually will see the improvement in your credit score over time. So again, quick walkthrough to answer the question that we asked in the AMA, what's the easiest way to get pre-approved or get to pre-approved in home ownership readiness? Leverage My Own Pathway. We're super excited that you guys joined us on this first AMA, and we look forward to more. And we have some questions from the audience. So we'll jump into the audience in terms of the questions, and I'll repeat the questions since you guys are not able to see, and then we'll go and be able to answer those questions. So again, ready for your journey? Start with My Home Pathway. All right, so we'll jump into question one. And again, if there are any other questions, please feel free to share, and we'll jump into those questions for the next 15 minutes. So question one, what should I know about buying in a competitive growing market like Sacramento or comparable? In terms of buying in a very competitive market, you have to also look at like other factors, population growth, income growth, right? Are there stable jobs coming to the area of Sacramento? What's the current home ownership rate, and what are the rental rates? And is home ownership at a much better price point than your rental rate? So if you're potentially going to pay $3,000 for a 3-bedroom, 2-bathroom, but you're paying $3,500 or even more, even say $2,800 for renting in the same kind of place that you would be able to buy a home for, you got to kind of look at that, as well as their tax benefits, right? When you're paying your mortgage, you get interest income tax benefits. You don't get that with renting, right? So it's a huge opportunity there. Looking at the price point in the Sacramento area, it's kind of a personal question. Do I make enough income to afford the type of home that I'm looking to be able to get into in Sacramento? And again, is Sacramento a competitive market that will continue to grow national average over the next 10 to 15 years? You got to look at home ownership as at least mid to long-term win. It is a short-term win as well, because I just mentioned some tax benefits, which are year to year, right? So you got to think of home ownership as a multi-prong approach, right? You have your short-term benefits in terms of tax benefits, you have appreciation, right? And that appreciation over time builds up to, on average now, $319,000 in equity, right? So it's huge current numbers. And will those numbers continue to grow? They will. So you have to look at like, hey, am I getting in right now where it will continue to even be a hotter market in 5 or 10 years or 3 to 5 years, right? So again, look at your income, kind of look at where you are in your own life cycle. And are you staying in Sacramento? And if you're not staying in Sacramento, would you consider being a landlord or have someone rent out that property from you if you decide to move to somewhere else? So you got to kind of consider that as well. If you are, again, going to leave the Sacramento area in, say, the next 2, 3, 4 years, right? So there are quite a few considerations when you're thinking about where to buy and at the right time to buy. Timing is always going to be interesting in the real estate market. I know interest rates are a little bit elevated, and so are home prices today. But as interest rates come down, you might see more buyers flood back in and make it even more competitive. So you kind of have to weigh those. I'll definitely reach out to a really local realtor and specialist in your area, and they can do some trends for you in terms of analyzing the Sacramento market specifically, and see kind of, again, what their thoughts are in terms of the 5-year trend, the last 5-year trend for Sacramento, the next 5 to 10-year trend for Sacramento, and is that a right decision? Am I going to stay in Sacramento for the next 5 to 10 years as well, is a consideration. Okay, and question number 2, how much money do I need for a down payment? Well, that one is going to vary. Typically, you're going to try to save anywhere between 6 to 10% for what you consider closing costs, well, cash to close. So let's clarify really quickly. Sometimes when the first time home buyers hear about to get a home, they only hear about down payment. The other part that they also have to consider is closing costs, which typically go anywhere between 2 to 4% of the price of the home. So when you take down payment and closing costs together, what they consider that as a lender is what you call cash to close, which is both your down payment and your closing costs. So you're typically going to look at something like, even if you can qualify for a 3.5% down program or a 5% down program, again, you have another 4% that you need to go look at. So you're on a safe side, safe bet. anywhere between 9 and 10% of the home purchase price. So if you're buying a $200,000 home, you're looking at $20,000 now. Now, again, in today's market, $200,000 is a little bit tricky, but that's about kind of the number that you're going to be looking at, 10% of the full price of the home. And again, sometimes depending on where you're buying, negotiation tactics, you can even get credits for things like the closing costs, right? So sellers may be able to pick up some of the closing costs, again, depending on the competitiveness of the market. That hasn't happened much in the last few years because the market has been such a seller's market, but those are considerations you can have. So that's where you're going to see things, again, to look at total amount needed, conservatively, back on envelope, 10%, right? And so look at what you kind of have right now and be like, hey, what's my gap? Is that 4, 5, 8%? And again, this is where down payment assistance programs that we can help you with come in handy, especially when you're looking in certain communities and areas. The next question, how to even start, how to obtain a loan when you have bad credit. What's the process start to finish? This is a layup. Us, we are the process, right? If you have bad credit, again, it's not a roadblock. It is a hump, right? So it's a speed bump, pretty big speed bump, but we can work with it, right? Depending on exactly what has occurred. If it's your thin file, like as you're a couple of years in, what they consider new to credit, it's about how do you expedite building your file and building your score at the same time. Or if you've had some challenges, you've had some missed payments, right? You may have had, a lot of credit card debt, which is, again, will be higher on your credit utilization, which may be causing your credit score to be lower. Could be that you had a bunch of credit inquiries all at once in a very short period of time. 20 credit inquiries are not good, and it doesn't look good for lenders. So your score may have reflected and dropped as well. So it depends on what the challenges are, right? In your credit score. And again, there are other products and tools and services and some of our partners that can really help you improve your credit score. So credit score is not a mountain, it's a speed bump. And so that's where we can definitely help you. So I would say, where do you start? You sign up, you do the process that I just mentioned in the AMA, connect your data, we'll gap assess you, we'll walk you through kind of where you need to go, what things you need to do to actually, and we'll build you that roadmap. We'll build you that pathway to get you to approval level. So credit score is not a roadblock. It's just something that we can help you work with. And what the other question, again, thank you guys for these questions. Really appreciate this, feedback while we're doing this AMA. What credit score do you use? I see different scores in different apps that I use. So our app uses Vantage 3.0. We may be changing that credit score in a bit to, again, make it a little even more proficient for our users. But our current score that we leverage is Vantage 3.0 through Equifax. Vantage 4.0 has also now been approved for mortgage underwriting. So that's another area that we're looking to dive into, to exploring what beneficial ways that we can really provide as much access to our consumers as possible. Other folks, again, Vantage 3.0 is probably one of the most popular credit scores that are shown by a lot of platforms. There are a few that show FICO, not as many platforms show FICO, but the typical one that we leverage is the Vantage 3.0 credit score. And the next question, what if I have been fixing my credit but still have derogatory remarks on my report? Would this be a disqualifying for a potential mortgage loan? It depends on what those derogatory remarks are. So with derogatory remarks, they're usually pretty bad, to be honest, depending, again, what that derogatory remark is. So you go back on credit reports, say 4 to 5 years ago, a lot of derogatory remarks were actually hospital bills, medical bills. Medical debt was a really big derogatory item on people's credit scores for quite some time. A lot of states And I think the CFPB is actually one of the regulators that have kind of reached back out to the credit bureaus around how they qualify medical debt and how impactful medical debt has been or should be for credit score issues and lowering your credit score. So actually a lot of states have asked the credit bureaus to remove any medical debt from their residents' credit scores. And so that's been a relatively big win over the last few years for a lot of people, because one of the biggest criteria for credit score reductions was medical debt, and especially missing payments on medical debt. And that was just sinking people into a bigger hole. So you're looking at like 20K average in medical debt, and you miss the payments, and you go from a 700 credit score to a 550 or even like a 620 credit score. And that puts even more pressure on your cost of capital, your cost of credit moving forward. So, those are, that's one of the items that I can kind of look at in terms of things that could be derogatory. You have bankruptcies, foreclosures, delinquencies. Some of those derogatory remarks or items get removed after a certain time. For example, with bankruptcies and foreclosures, typically about 7 years that they last on your credit score. So again, if you're in like year 6.5, typically within the 7th year, they should be off your credit report. So some of them have some timing implications to them. So it just depends on what that derogatory report, the remark is, right? Again, foreclosures, bankruptcies are the big ones. And actually, even the derogatory remark for a foreclosure, there are GSE programs, government-sponsored entity programs, that you can still get a new mortgage with a foreclosure, but typically outside of 36 months. So if you've had it within a foreclosure, for example, within the last 24 months or last 18 months, it'd be pretty hard. But you've had a foreclosure 4 years ago, 5 years ago, it's less impactful. It still may impact your score, but from a mortgage qualification standpoint, that's not a roadblock is to say, nope, you can't get a mortgage with a foreclosure or bankruptcy on your credit report. And for the final question, we'll be wrapping this up in a couple of minutes. With interest rates always changing, how do I know if it's the right time to buy a house, or should I wait for rates to drop? What's your advice for timing the market? So I'm gonna give you super simple advice. Don't. If you're trying to time the market, you're not Nostradamus, and you end up sometimes going to pass on some great opportunities. So the piece that you should actually think about is, hey, if the interest rates are a little bit higher now, I can get into a home and I can refinance when the interest rates come down. So getting in is the first object, right? Yes, again, you want to get in typically in the right market, right? You don't want to jump into a lot of times you see some markets that are getting under a little bit more challenge, right? So you're seeing where their list prices are dropping 30-40%. So you may not want to jump right into those type of markets. But on typical across the country, just because interest rates are a little bit higher, we want what we saw before in 2020, 21 with 3% rates, 3.5% rates, 2.5% rates. That was historic. Never happened before. And don't lock your brain into that 3%. Look, because on typical, what you're usually seeing in the market is about 5% interest rates on mortgages. So that's hopefully what the normalized mortgage rate gets back to. But the worst case, you can get into a home at 6.5%. And as those rates drop, because you're already in the home, 6 months, 8 months, a year later, you can refinance down to the current rate. So the current rate's 5.5%. You can refinance down to that 5.5% rate. And again, that will alleviate some of the interest pressure on your payments, and that hopefully free up some additional cash flow and capacity for you. So I would say if you're in the right position, you have the right profile, you found a comfortable home that you can afford, jump into the market. Because again, you're paying rent all this time, and you have no advantage in terms of the tax write-off on your interest payments, right? For that big part of mortgage. So that can also help you. So you have to think about the mortgage, getting the home buyer experience as a comprehensive experience. and, truly look at your financial picture and the full aspect of what homeownership means to you. So again, thank you guys for all those great questions. Please share, invite your friends. If you know anyone that's looking into homeownership and may not have a great profile, jump on in, tell them about that first step, sign up for My Home Pathway, connect your data. Let's get you on the road. So thank you guys again for joining us in our first AMA series. And we look forward for you to join us on the next one. Share this information with others that you think this could be impactful for. And we're super excited to continue this journey with you. Thank you.